what happens is as you move through the big cycle, the super cycle, every cycle ratchets up more. So it's like, you're getting more volatility in inflation and in everything as you move forward. You have bigger downs, bigger ups as you move to the end. And I think we're at the end of the super cycle, which I define as the big cycle between two depressions, the depression of the 1930s and the depression of the 2030s. So this is a bust. This isn't a depression. What's coming, their response to the bust will then bring us one last inflation cycle that leads to a depression far bigger than the 1930s.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for January 3rd through January 10th, 2023, while supplies last. This week we feature both of the only regularly minted 4/9 fine silver coins in the world. Silver Maples backdated and Silver Kangaroos from 2022 at just $4.19 over spot. Both the backdated Silver Maples and the 2022 Silver Kangaroos are renowned for their purity, recognizability, and design. They both come 25 to a tube, and Maples are 500 to a box, while the Kangaroos are one of the most affordable boxes around with just 250 coins. We have both coins in stock and ready to ship, and both at just $4.19 over spot. And finally, both are IRA eligible. If you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend David Hunter, a contrarian macro strategist with over 49 years on Wall Street. Is it 50 years now?
It'll be 50 in, I guess, the end of May.
Fantastic. Well, we really appreciate all your experience there. And also, people can find you on Twitter, and also you have your newsletter, and they can contact you through there. What I wanted to discuss today first was the metals markets. I know that you're very bullish on the metals. We've seen quite a bit of a rally in the last couple months, and it seems like it's continuing in this new year. You're thinking that silver could hit $50 this year?
Yeah, I think even 60 is possible. And that may not even be aggressive enough. So I think silver's in gear. I think gold is in gear. And if you look back last year, it's uncanny how much because it really was slow getting started. It bottomed, I think, the end of September, and both gold and silver. And it coincides with top in the dollar. And if you really look, the dollar took off after Russia invaded Ukraine, so last spring, and it was all downhill for the metals for much of the next 6 months. So I really think what we're seeing here is the reverse of all of that. The dollar is rolling over. It's come down pretty fast here in the last few months, and gold and silver are starting to pick up. So I look for 2023 to be a really strong year for the metals. I also am expecting the dollar to come down hard. So if I'm right, I think you're going to see the biggest rally in gold and silver that we've had in more than a decade now. Had a great run the first decade of the century, and kind of went to sleep from mid-2011 until now. It's had some rallies and stuff, but it's really been a long period of kind of consolidating a huge run that first decade. And I think we're about to see the beginning of that next leg, very big leg. So I think gold can get to 3,000 here in the next 6 or 8 months. Silver could get to, as I say, 50, 60, maybe even higher in that same time frame. And it's not going to go straight up. There'll be periods of consolidation in there, but that's a huge run with silver down around 24 and gold down at 1,800 and change. If we see those kind of moves, those are big moves. So obviously the story to me is what I think is going to be a very weak dollar, probably big move in interest rates, and on the way, interest rates going down, and the belief, I think, which will help a lot both the equity markets and gold and silver, is a belief that the Fed is nearing the end of its tightening cycle. Once people become more convinced of that, I think it's wind at the back of these metals.
Now, when it comes to interest rates falling, it's definitely not what we've seen in the last year. So what is convincing you that maybe the Fed will pivot, or that interest rates will actually be coming down soon?
Yeah, it's not even a pivot. I'm not necessarily. I mean, the Fed could surprise us and pivot, but they've been very clear that they believe that there's still a good ways to go in tightening, and that you'll probably see rate hikes through this year. So what I would say is the Fed could pause here in the next few months, because I think the data is going to come in weaker than they expect on both inflation and on the economy. I've said for quite some time, the Fed is making what I think will turn out to be the biggest policy error in the history, maybe, of the Fed, but certainly a very big one in terms of over tightening. And a lot of it stems from, first of all, they were slow to recognize inflation. So I think they are trying to earn their stripes back, earn their credibility back by staying the course and saying, we really are inflation fighters now. Powell's made reference to Paul Volcker. He wants to be thought of in that light, I think, that he's tough on inflation, and he understands it takes some tough medicine to get there. So that's in their psyche. And then, last April, Bill Dudley came out in a speech and talked about because of the long equity run we've had, that wealth is a big part of financial conditions, and that until we really wind out that equity premium, until we see equity markets down a lot, you don't have tight enough conditions to wind out or to unwind the inflation spiral that we had. So Powell, very clearly, you could see it going back to the middle of last year, very clearly took that to heart, bought hook, line, and sinker what Dudley was saying. And from that point on, and certainly the second half of last year and into now, every time the market lifts its head, out comes either Powell or typically some of his minions, Mary Daly at the San Francisco Fed, John Williams at the New York Fed, Bullock, Messer, any of the FOMC members, out they all come. And you saw it again today, and they're trying to talk the market down. They are clearly trying to jawbone the market lower. And it's, I'd say, if you were asking Dudley to pick a number, he believes it has to get down to 3,000 or lower. I think Powell buys into that, low 3,000s or below. So the Fed is almost not solely focused on that, but that's kind of front and center in their focus. And I think it's dead wrong. I mean, the stock market is not where the Fed should be thinking they're an expert. They should not pick a number and say, we think the market's overvalued or we think this. The market is a leading indicator. In the aggregate, the market is a much better predictor of the future than the Fed will ever be. And by trying to force the market down, he's going to have his head handed to him. If I'm right about where we are, we're on the verge of the biggest market rally this year. I think we will see the biggest market rally potentially in history. I'm calling for big numbers on the upside. And, Powell has got the street convinced that it's going a lot lower. So everybody's positioned negatively. Everybody's bearish. People are worried the Fed is going to cause a hard landing in the economy because they don't seem to understand leads and lags. So all of that is playing out. And I think we're really on the verge of what is going to be, move up in the market. Again, it won't be straight up. You'll have some places along the way where it stops. But I am calling for, have been calling for, as you know, 6,000 on the S&P. And I say 6,000 plus because I think that's going to prove to be a conservative number. I think it could go 6,500, 7,000. Once you're in the blow off mode or the melt up mode where it's going vertical, there's really no way of knowing exactly where it stops. But I think we're talking about, first half of this year, a market move of that magnitude. So if you go from 3,800 coming into the year to over 6,000 in 6 months' time or less, could be less. That's a heck of a move. I don't think we can find many moves like that in history. So, and again, the Nasdaq, I'm calling for 20,000. That's basically a double from where it's been. The Russell 2,000, I think, can get to 3,000. The Dow can. I have a number of 45,000 for the Dow. All of those numbers, particularly the S&P and Dow, I think, are going to be proven low. That will exceed my targets. So that's a pretty big statement about how wrong the Fed is going to be by targeting equities and saying we want them down at 3,000. What's he going to do? When the market all of a sudden is 4,500, is he going to say, well, I know where the market should be. It's 1,500 points too high. And they're going to keep trying, or is he going to finally wake up and realize, I shouldn't be focused on the stock market. The economy is falling out of bed. I think a lot of what's going to happen this year is due to this Fed policy error. They're probably going to recognize in the first 2 or 3 months of this year that maybe we need to take a step back because the economy is not looking good and inflation is coming down faster than we thought. And they may pause, but I think they're going to be reluctant to pivot. So they could pivot, but I think they'll probably pause. And that pause will only give more credence to the bulls in terms of saying, see, the Fed may be done. But remember that Bill Dudley speech and what Powell believes. If we see an S&P at 6,000 or 5,500, 6,000, wherever, up there, he's going to be even more adamant that, wow, this thing's out of control. We've got to tamp it down or else inflation's not coming down much, or it's going to break out again. So I think he will come back. If he pauses, my guess is he'll come back and make even a bigger policy mistake in terms of hiking again and tightening into what is already a very soft economy. So ultimately my prediction is that this will all lead to a global bust. Probably second half of this year is when that begins. We'll have soft landing recession first half. I'm not sure how soft, but some sort of recession first half that morphs into a much more severe downturn as it moves along this year. And again, it's a global bust. So this story is across the globe. It's not just U.S. The ECB is making the same error. The Bank of England, Bank of Canada, Bank of Australia, Reserve Bank of Australia, and even China. People's Bank of China. It's gonna end up very badly. But in the first half of this year, with everybody positioned negative, I think we're really set up for one last, what I call last hurrah in the market that takes us to all-time highs, substantial all-time highs. And I think the high watermark this year, whatever time of year it happens, if we get to 6,000, 6,500, wherever it is, I think that high watermark will stand for decades. I think this is a secular top of a secular bull market that started in 1982. And, whenever it tops out, I think it is in the first half of this year, we will have that followed by a historic bear market, probably the biggest bear market since the 1929 crash. So we could see an 80% decline. I obviously don't know whether it's 80%, 70%, 85%, 75%, but some big historic bear market that we'll be digging out of for many years. We'll have a cyclical bull market to follow this, but you won't get back near the highs. Part of that will be inflation and interest rates and things like that. Higher interest rates will be holding back the market. But for at least the next 6 months, I think it's some pretty nice sailing, and then second half may look very different. As I said in my, I'm saying in the letter I'm writing now, it'll be basically a tale of two cities. First half, strong market, weaker economy, but not disaster. Second half, at some point, second half, disastrous economy, disastrous stock market. Metals in all of that probably peak out after the stock market, but they will go down in the bust with most assets. So there'll be a time probably to exit gold and silver and the miners, mid-year or after. But until then, it's going to be, very nice moves.
With respect to precious metals, those are, and really all the markets you're talking about, those are dramatic moves you're looking for. You say that precious metals will also top out. It seems like we have seen this in the past when we do see a downturn in the stock market. And often, precious metals do follow, at least initially.
Yeah, the problem is this global bust will be a global deflationary bust. So obviously that's not good for metals, particularly silver. I mean, silver is a very cyclical metal, gold a little less so. But yeah, if you're going to have an economy that's potentially the worst economy in the post-World War II era, worse than 2008-9, maybe the worst since the worst since Great Depression. If you're going to have that kind of a global economy, demand for all commodities and demand for metals and everything else is going to go down, and down sharply. So I think that's going to be a big problem for the metals. And probably in the global bust, like I'm calling for a huge decline in the dollar in the first half of this year. But in the global bust, I think the dollar, as it always is, will become the flight to safety trade. So you will see the dollar back up in the global bust later this year. And that, again, will be problematic for the metals. So there's lots of reasons why you can have kind of a very very strong first half and a very weak second half.
Now, for those people who are really looking at precious metals long term, do you think that that's a good option right now, or is it more a thing to trade right now, where it's going to be increasing the first half of the year and then maybe for the next couple of years it's just not going to be a good asset to hold?
Yeah, I can't give investment advice, but what I can say is my belief is that the lows we saw in September, October are not likely to be revisited in either gold or silver. So, 1650 or whereabouts it was in gold. I think silver got down under 17. So $17. So I don't think we're going back there. I'm not sure the levels we're at now are going to be revisited in the bust. They could be. But I don't think we're going much lower than this if they do get revisited. So from here, I'm talking about the balance of the decade. From here, you may not see these levels again. And if we do, I don't think you're going to undercut them by much. Once we get up to 50, 60 or higher in silver and 3,000 in gold, and again, I may be too low on my targets, but somewhere in there, then you've got risk in the bust where, let's say gold goes back to 2,000 or back to 2,200. That's a pretty good hit. So it's up to people whether they want to ride through that or not. Silver is going to be more volatile. So let's say it gets to 60, that could go back to 30 easily, or, 25, 30. So that it'd be a big hit. But the other side of the coin is that on the other side of this global bust, and I call it a bust because I don't think it lasts many years. It's the damage of a depression but in a concentrated period of time, like a recession. So by 2025, maybe second half of 2024 into 2025, we'll have a cyclical recovery because central banks will be printing money like crazy to respond to the bust. And I think the second half of the decade, 2025 to 2030, gold can go to 15 or 20,000. Silver can go to 400 or 500. And I'm not sure I even have high enough targets, but that's the kind of potential metal has. So we're sitting down here at, 24 on silver, and almost 19 on gold. Compared to that, there's huge upside. So certainly those that want to be buy and hold people, they just have to know there's going to be some volatility along the way.
Can you explain, is there really precedent for these kinds of moves in precious metals?
Yeah, great question. I don't know that these kind of moves, maybe not, but let's look at the first decade of this century. So from 2001 to 2011, gold went from 250 to 1900. So I mean, it had a whatever that is, a 7 or 8 fold increase, I think. So, and silver went from, low single digits all the way up to 50. So, there's plenty of precedent for these, many, many times moves. And what I would tell you is going to drive this move after the global bust is, as I said, you're going to have, and I throw around these terms, and I people now use the terms a lot. I started using them before anybody, but melt up and bust are terms that you see out on the street all the time now. Yet when you talk to people, they're using them in a different way than what I mean. A melt up is a parabolic melt up where you're going to have, like I said, you're going to, let's say I'm moving to the equity market for a second just to explain, but let's say the S&P moves to new highs, over 4,800. From 4,800 to 6,000 or 7,000, you could cover that ground in a matter of a month or two. So to cover, 1,500 points, let's say, in a month is almost unprecedented. I mean, that's just straight up. That's a melt up. The rally that we have going there is going to be really nice, but it's not the parabolic part of the move. The parabolic will be at the end of the move. The move in gold and silver, it's going to be driven by this massive money. We're going to have this real crack up because the Fed's over tightening, the central banks around the world are over tightening. When I say melt up, that was an explanation of melt up. When I say bust, people kind of think bust means recession, I think, or bust means, and bust refers to the economy when I talk about it, but people use bust to talk about a busted stock market, going into a bear market, whatever. When I say bust, I'm talking about something that is the magnitude of a depression in many respects, a financial crisis of historical proportions. So something like 2008-9, except we stopped it before it turned into a bust. The commercial paper market was about to freeze up, and GE was about to go under, and the major banks were going to fail. The major New York City banks were going to fail. AIG was going to fail. All of that, the central banks of the world stepped in the nick of time and saved us from a bust. When I say bust this time, we're going to go that next step. You're going to have major bank failures around the world. You're going to have a financial crisis much bigger than 2008-9, in my opinion. So if I'm right about that, and you're going to have an economy that's, going straight down, if I'm right about that, it's going to mean the Fed, and there's no doubt central banks, no matter what they think now, are going to have to step in ways they never imagined. So you will see money coming out of every central bank in proportions that have never happened before. I'm predicting that you could see a $30 trillion Fed balance sheet. It's got up to $9 trillion after the pandemic, and we're 8 and change now. I think they'll have to print money to the tune of $20 trillion just to stem the free fall in the financial system. And every central bank will be doing proportionally similar. So you will have this massive money print that we've never seen in history. And that will, with a lag, trigger the recovery cycle, but it'll also trigger an inflation cycle coming out of what I think is a temporary deflationary bust. you will see an inflation cycle like we've never seen before. So you could go in 5 years, you could go from negative inflation, let's say next year or late this year, to potentially 25% inflation by the end of the decade. So we think it's bad now when you're talking 8 to 9% inflation, or bad back when it was, in the high teens, back in the early 80s. We could exceed all of that and be 25% in 5 years. And interest rates will track that. So interest rates will be going through the roof. But gold and silver will be one of the big games in town because, they can trade on inflation. So, or they are considered inflation hedges. And by the way, what I think the next recovery cycle will be very much a commodity cycle. So we'll see commodity prices in general go through the roof. So you could see $400 oil. You could see gas go to wherever, $30 or more, $50. You could see copper, go up tenfold or more from here. You could see, ag prices, wheat, corn, all of those things go through the roof. When you put out that kind of money into a system that's proportionally way beyond anything a system normally would require, it will ultimately lead to price increases like we've never seen. And it will take time to bring that back down, and policies to bring that back down that, could end in a real crack up on the other side of all of this. But in the meantime, I think the precious metals will be the place to be.
Now, how do you see this impacting the standard of living for people in the U.S.? Because it seems like we're almost, what you're saying is kind of entering into a Venezuela or Zimbabwe type of situation. Maybe not that dramatic, but pretty close, it seems like.
Let's put it this way. This has all been building for decades. We didn't get here with Jay Powell. We didn't get here with Bernanke. We got here, decades and decades ago with all the spending we've gone. What happens is as you move through the big cycle, the super cycle, every cycle ratchets up more. So it's like, you're getting more volatility in inflation and in everything as you move forward. You have bigger downs, bigger ups as you move to the end. And I think we're at the end of the super cycle, which I define as the big cycle between two depressions, the depression of the 1930s and the depression of the 2030s. So this is a bust. This isn't a depression. What's coming, their response to the bust will then bring us one last inflation cycle that leads to a depression far bigger than the 1930s. So, yeah, standard of living is going to be hurt. People's incomes are not going to keep up. It's going to take a lot of years. We saw it in the late 70s, early 80s. Ultimately, companies adjust and the government adjusts to inflation by putting in inflation adjustments, so your income is somewhat tied to inflation and things. That's a kiss of death, but it will take a few years for them to even implement things like that. So, if the inflation, let's say, really starts in 2025 or 6, you're talking about, the end of the decade before you really get the adjustments across the board where you're kind of building in income to match the other. So in the meantime, your prices are going up, your income's not keeping up. So you're going to have loss of real income. And I do not think the consumer is going to have, from here to the end of the decade, we're going to have a very different consumer than what we've had in the last 30 years. They're going to be struggling just to meet basic needs, heating oil, gasoline, costs of home builders, building a home. All those things are going to be through the roof. So are grocery costs and everything else. So this is kind of the precursor to it. But this inflation cycle has been going to be, it's not like we're going to go up from here. We're going to go down first in the bust. Not all prices, but generally you're going to see the broad price indexes go into deflation temporarily. And then you start this inflation cycle, which, is really a follow-on to this. but it'll be so much faster and steeper.
All right. Well, it sounds like it'll be a very exciting road ahead, but very something that we want to prepare for as well. So we'll definitely continue to track this with you, David. If our viewers are interested in learning more about your writings and reading that, your newsletter, how can they find you?
I'm on Twitter, as you said, and they can reach me at Dave H. Contrarian. So it's at Dave H. Contrarian is my handle on Twitter. And then I do have a investment letter, as you mentioned. If people are interested in it, it does come with a subscription cost. So if people are interested, they can direct message me and I'll provide them details. It's a quarterly letter, so it's not something that people trade off of. It's really more of a macro letter. But we're in interesting times, and I will say I've gotten beaten up on Twitter a lot because my forecast is by far the most bullish forecast out there. And with so many people bearish, it looks idiotic. I mean, I am so contrary right now, but I'm forecasting what I see in my work. I've been a contrarian for 50 years. I can speak with conviction on something that's totally outside the realm of most people's view of possibilities right now. But it's not because I'm pumping something. I'm speaking with conviction because it's so clear in my mind where we're going here. And this is what happens at bottoms is everybody gets on one side of the boat and is looking completely the wrong direction. So this is an interesting time for a letter like this because, lots of times, everybody has an opinion that's not that far removed from everybody else's opinion. But right now, I'm as extremely far away from the consensus as you can get, and yet my conviction is extremely high, and that's a rare combination even for me.
Any last thoughts before we let you go, David?
The only thing we touched on slightly interest rates, but I do think the 10-year right now is starting to move lower, and people are confused by that. As I keep saying, the bond market is the markets in general, much better predictors than the economists at the Fed. So with the Fed talking about hiking rates, it's confusing a lot of investors because the 10 years moving down from, it was 390, I don't know, a week ago or a little more, and it's now under, 360 or under, going toward 355. I believe you're going to see the 10-year down to 2.5 within the next few months, the 30-year probably under 3% in that same time frame. And then ultimately in the bust, and again, that won't be a straight line, but in the bust, I think you're going to see new all-time lows in rates. So the 10-year can get to zero and probably negative rates, and the 30-year probably down to a quarter or a half. Again, those are unprecedented huge moves from where we just were. And remember, most economists up until very lately, we're talking about rates moving even higher because they're looking at the Fed. Well, the Fed's hiking rates, but who cares about overnight money? The markets look at the longer government rates, and they trust those rates more than they do the Fed's opinion on where rates are going.
All right. Well, David, once again, thank you so much for your time today. We'll have to reconnect in about a quarter here and see, where we are at that point. But thank you so much for your time, insights today, and God bless.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. you will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.